Hi everyone, welcome to the channel. If you're new here, this is just me trying to build a $500 tax-free savings account to a $10,000 account through investing in dividend stocks primarily. So if you want to follow along with the journey and the channel and my buys and sells and what I learn along the way, just subscribe to the channel and please leave a like and a comment. And the stock market's been pretty volatile as of late. The prices haven't been, just consistently going up nonstop. So we're actually down $141.51 for the week and a total of $9,305.17 in the portfolio. In the past month, we're down about 1%, so not much progress here. Past 3 months, we're still up 1%, and all time, we're still up 740.17 or about 9%. So just going through the positions that we added to since my previous update, I keep buying a little bit more of Scotiabank, so we're up to almost 8.25 shares here. We bought another share of Smart Centers just because I wanted a bit more real estate and the price went down, and so I decided to go from 15 to 16 shares. We also bought a little bit more of TD Bank. So same thing with Scotia. Our strategy is just to invest in the Canadian banks fractionally whenever I can, unless I see a better opportunity come along, just because I think they're good value at the moment and they provide a very good dividend, especially since they just raised them. Like BNS raised it by 11%, TD raised it by 13%. So the dividend yield that you get for these two companies is higher than it's been in a while. And I also added to my Tesla position just because this one has been going on a bit of a dip. So every time it drops, I'll just try to add a little bit more Tesla here and there. And it's mainly just, news about Elon Musk selling his shares. But honestly, he needs to sell his shares because he has to pay a lot of tax. So that's probably why there's a lot of negative price movement on the stock currently. And I buy all these stocks and ETFs on Wealthsimple Trade. They offer no commissions on Canadian listed stocks and ETFs, and they also offer fractional trades on over 200 different stocks. So join my link in the description below to get yourself the value of a free stock. Now I'm going to discuss the power of compound interest. So compound interest, for those of you who are unaware, is simply reinvesting the return that you get or the dividend that you receive from the stocks that you hold. So, let's just, in this example, say you have one share of TD Bank and it costs about $95. And for each share you own, you're going to get $3.56 per year as a dividend payment. So the company will pay back their shareholders this amount of money every single year for each share they have. Now, if you reinvest this money back into TD Bank, you're going to earn, your next dividend payment is going to become larger by this amount of money, and you're going to earn additional interest, and you just continue depositing money back into TD. And this just generates a compounding effect as all your previous payments keep getting added on, you're getting more and more income. And I'll demonstrate that in a chart. So in this chart, I've actually inputted a simulation saying that, let's say we're going to buy 100 shares of TD at $9,483, providing an annual dividend income of $316. And we're just going to assume that the stock is going to continue increasing its dividend at the 5-year average rate, which is 8.8%. So that's the average amount that TD Bank raises their dividend. So I usually target stocks that grow their dividend at a high rate, because over time that's going to add up significantly. And so we start at basically $316, and then we can see after 10 years, without investing a single dollar more, just reinvesting our dividends, our portfolio value goes from $17,556, which is practically doubling our principal. So your initial investment has doubled in value, and your annual income goes up to $908 from $316, which is a tripling of your dividend income without investing any more money. Now, if we invested, regularly into the bank and kept acquiring more shares, this number would grow even higher over time. We can extend this out to 15 years, and we see that our portfolio would continue growing. It would give you an annual income of $1,700 per year and a portfolio value of $26,000, which is, nearly doubling it again. After 20 years, we're going to be getting $3,846 in dividend payments and a portfolio value of $43,000. So nearly quadrupling our initial investment. No additional money is being invested. This is just reinvesting the dividends that TD Bank is paying us every single quarter. And then the final total, the portfolio value would be $77,000, all the way up from our initial about $9,000 or so. And the annual income increases to $8,197. So the dividends that you're earning after 25 years on TD Bank, after all the dividend growth, all the raises, is nearly the amount of money you initially invested. So that's why it's important to start investing as early as you can, because later on you can see that if you keep reinvesting the dividends, keep sticking to this simple strategy, you can generate a lot of wealth for yourself and actually have a good retirement, not just hope for one, because a lot of people have issues with budgeting and investing and setting aside and just making investing a normal habit. Treat it like a normal bill, and 25, 30 years into the future, you're going to have a nice stream of income. You're going to have a bit more freedom, and you may not have to work a job into your 70s, which some Canadians are actually having to do. So have a great day, everyone, and just keep investing no matter how the market looks, just because over the long term it doesn't really matter. You just have to be consistent.